let's assume that Donald Trump is back in the White House in 12 months from now. Is it going to alter the picture in Ukraine a lot?
It could very well. I mean, right now we see the U.S. Congress is debating heavily whether to extend the support and the funding for Ukraine. I think if Trump comes in, that pressure is going to be even more remarked, and Ukraine basically is sitting on a time bomb of the U.S. cutting off funding.
You're listening to Macro Sunday, hosted by Andreas Steno. Hi everyone and welcome to the Macro Sunday podcast. I'm Andreas Steno, founder of Steno Research, and today we're going to discuss whether the recession is called off. We've had a tremendous start to the year, especially in US key figures, but can we actually trust the numbers? It sounds like a big conspiracy theory lined up here. It's not, but there is actually a relevant discussion on the validity of these numbers. Coming up in just a short while, I'm joined today by a couple of my friends and colleagues. First of all, you, Mikkel Rosenvold, welcome to you.
Thanks for that.
You are head of geopolitics here at Steno Research, and then we're joined remotely by Emil Møller. Welcome to you, Emil.
Hi, guys. Cheers.
Good to see you again. Guys, first of all, let's remind the audience that all of this is an appetizer to the loads of articles, the live portfolios, etc., that we run at stenoresearch.com. If you're interested in institutional coverage or anything the like, please contact us via stenoresearch.com. You can always get a 14 days free trial to our research offering. Having said that, it's been quite the week, both in macro and geopolitics. And since we're recording on Friday, Mikkel, I think it's timely to discuss the Tucker Carlson interview with Vladimir Putin, first of all. I mean, a lot of attention was obviously given to this interview ahead of it. Tucker went to Moscow. He highlighted this interview ahead of the interview actually airing, etc. Was it a disappointment?
Yeah, I had such low hopes, and I was disappointed still. So in my opinion, it was a bit of a shit show of an interview. Putin was rambling on about Russian history, how the Vikings founded Russia in 800s. I don't know how that's relevant to anything anymore, and all that. And it was and Tucker Carlson basically lost control of the interview. Enough about that. You can hear enough criticism of Tucker Carlson all around the place. So let's not delve into that. Yep. What I withdraw from this interview is that Vladimir Putin basically failed to grasp the chance to put out to convey a compelling message to the Western audiences. I would have thought that he had a better plan for this, that he would come across with some messages that actually make sense in Western minds, not that Poland started World War II and what have we. That's the one thing. The other thing is that Putin seems hell-bent on this mission to at least partition Ukraine and to basically, for as long as he's in power, as long as he lives, to wage some kind of war with the West. So this was far from the conciliatory let's make a deal thing that people were hoping for, and some people read into this. I don't read that into Putin's remarks at all. He seemed very hell-bent on destroying the Ukraine as we know it.
But is this Vladimir Putin gaining confidence that he's actually gaining ground in Ukraine?
Yes, absolutely. That's the way I see it. And he said that pretty much. He said it's impossible for Russia to lose this war. And I actually agree with him on that. That is a correct analysis, for at least for as long as he lives. That is the base case scenario. That's what we're looking at. And that's the dilemma the West is facing, as we've been talking about a lot here.
Yeah. And speaking of interesting leaders of nations, here's the Trump soundbite of the week. Donald Trump made some remarks on Fox News the other day surrounding the stock market in the US and his impact on the current rally.
The Biden team can say, well, if things are so bad, how come the stock market's on a roll?
Because they think I'm going to be elected.
That you think the stock market's rallying because people think you're going to be elected?
I do, yeah. If you take a look at Iowa, if you take a look at New Hampshire, the stock market's been going crazy. since then, and long before then. When I announced I was running, I took the lead early, and then I beat everybody, including Ron DeSantis. I call him DeSantis now. I took the other name.
Mr. President, back to the economy for a second.
Tremendous stuff.
Incredible.
So, first of all, we'll get back to the discussion on the U.S. equity market in just a second, Mikkel, but I'd like your take on Trump in relation to Putin. I mean, let's assume that Donald Trump is back in the White House in 12 months from now. Is it going to alter the picture in Ukraine a lot?
It could very well. I mean, right now we see the U.S. Congress is debating heavily whether to extend the support and the funding for Ukraine. I think if Trump comes in, that pressure is going to be even more remarked, and Ukraine basically is sitting on a time bomb of the U.S. cutting off funding. The EU doesn't really seem able to replace that. We're not producing enough weapons to do that. So this puts a lot of pressure on the new Ukraine head of chief of staff of the military to gain some wins in the short term, which I believe is not really realistic. So the Ukraine and the West are facing a tough dilemma. Are they going to try some negotiations with Putin? I don't think Putin is in the mood for negotiations, but it could be the only choice left for the rest, really, especially if Trump takes power.
Yeah. Emil, do we focus enough on this conflict in Ukraine from a financial markets perspective currently? I mean, it seems like we're, from a markets perspective, sort of stuck in a stalemate, right? It's not really a driver of things right now, but could it turn into a driver again?
Yes, it could flare up and accelerate in the event that risks of some sort of resolution comes into play, right? Then markets will move. I mean, if you the first whiff of sanctions getting pulled away from the table against Moscow, and oil markets are going to have a party, or rather, the spot market is going down, right? But no, I think that, I mean, the current juncture we find ourselves in is simply that of and expectations of the current conflict just remaining stalled. And if I was to add a few remarks to what Mikkel just said, I completely agree on overall. But I think an often overlooked aspect is the Chinese both capacity and indeed willingness to supply Moscow with both the financial and the goods and technology and everything else that is needed to sustain the war effort on Russian part. And we're already starting to see a few ramblings in terms of being the financial mediator, and also, crucially, there's plenty of issues in China domestically. Meaning that it's going to take its toll if it's going to be a sustained conflict. So I think that's sort of the juxtaposition we find ourselves in.
Breaking news: we have issues in China.
Yeah.
To say the least. In relation to this soundbite from Donald Trump, he obviously refers to his victory in Iowa and New Hampshire as a trigger for optimism in the U.S. economy. I don't know whether I buy that notion or narrative fully. But if we look at the positivity that we currently see in the U.S. economy, I mean, tremendous key figures all over the place. Strong job report in January. We can discuss whether we can take that as at face value. I don't think we can. But very strong signals from consumer confidence relative to what we saw last year. Extremely strong signals from the Institute of Supply Management, also from the service sector. Emil, is the U.S. economy accelerating here? Is that really the true signal here?
Yeah, the question is merely by how much. I think what you really should look out for when you look at the American economy is essentially just the consumer base, because that's 70% of the economy, right? And what will move their agenda, and what will they do? I think the risk, or rather the perceived risk of credit defaults and all that is definitely taking the backseat right now. But I think that the overall momentum in the economy, also when we look at the private sector, is essentially just a reflection of a fundamentally unbalanced economy that is, I mean, best estimate, probably growing around potential right now, but it's doing so on the back of a 7% budget deficit.
Yeah.
So some sort of readjustment has to take place one way or the other, and unless it's done cautiously, and in baby steps, so to speak. I mean, you have the recipe for trouble. I can tell you that as an EM guy. Sometimes when that happens, run for the hills, kids. That's what I would say.
Yeah.
But so far, so good. I think Yellen is in the front seat. That's how it looks.
Yeah, and I mean, it will obviously be very, very tricky to remove the stimulus ahead of the election date, right? All incentives point in the direction of further stimulus to the economy for as long as we're in an election season. I guess that's safe to say as well.
Yeah.
Mikkel, when we look at the fiscal trajectory in the US, it seems like this discussion of a so-called cliff edge scenario is one that we have to take on the other side of the election.
Absolutely, and it's going to be interesting whether Trump really can do much about that. His solution that he'll point to is perhaps this tariff idea. He's been talking about putting 10% tariffs on all goods, which would bring in a lot of money to the federal government. At the end of the day, would pull a lot of money out of the economy. It's not going to be implemented all across the board, but he will increase some tariffs that will bring some revenue in. But he will have to look at spending as well, of course. He can maybe do so in a choose and pick manner to pick out the things he doesn't like, but he's going to have a very tough time working with Congress on that. So it is going to be another 4 year, especially Trump wins, of battles over appropriation, debt limits, all that we're getting used to.
Yeah, and speaking of tariffs, and especially tariffs on goods, I think it's timely to bring in China to the discussion here. When we look at Chinese inflation numbers right now, Emil, we had the latest set of numbers last week. We're looking into a deflationary spiral, basically. I know there's sort of a technicality around the New Year's seasonality that could wreak havoc with the numbers here, but still, I mean, the trajectory is definitely towards lower prices in China, being deflation, right? So is this an isolated issue for the Chinese government, or is it something that you expect to sort of spill over to regional economies, maybe even the global economy?
Locally, yes, to a certain extent, simply because China is such a big economic powerhouse within its own realm. But to the global economy, less so, and that's in part due to what the growth model of China basically has embedded in it is goods pricing power and thus deflation, because what they basically are doing is throwing credit and money at the entire export and manufacturing sector to basically outcompete the rest of the world, and that's inherently deflationary. Of course, it's very pathological given that it doesn't really address their own domestic issues at all, but it ramps up their trade surplus, and that means they need to export capital to an extent. So yeah, it's definitely an issue. But what I will say is, when we talk about deflation, we shouldn't really we should be cautious about like spiral. That's a big word to use here. But what I will say, it's really all about expectations, and that brings us back to the real estate problem, right? Because one thing is having deflation. What that basically means is, consumers will be better off saving because they can buy something cheaper tomorrow. But it's really about what do they think will happen in the future. And so far, the Chinese government has just completely failed at turning the credibility on price pressures here. So that's where we're at, I think.
Yeah. And if you look at it empirically, the PPI, the Producer Price Index of China, is a pretty decent leading indicator of, say, Japanese price pressures, Korean price pressures in Thailand. But the capabilities of Chinese price indices as leading indicators for Western price pressures, those capabilities have basically waned over the past 3 to 4 years, partially as a consequence of a sort of a lack of trade ties relative to what we saw in 2019. But of course also partially due to trade patterns being sort of rerouted. And I mean, take a look at the export numbers from China to LATAM, and then the export numbers from LATAM to the US. They basically sent goods via sort of a middleman to the U.S. to a certain extent, which alleviates some of the direct pressures from these price trends seen in China. And speaking of LATAM, Emil, I know you've been you've basically lived there for quite a while.
Yeah, I have.
And
Yeah.
Mikkel, I know you followed the situation as well. Jair Bolsonaro is, I guess, on the verge of being arrested. As far as we know, he's not arrested yet, but his passport has been seized. Some of his basically personnel and supporters, key supporters, have been arrested over the past week. Emil, what's going on in Brazil here?
God knows. It's basically the kickback from the ongoing police investigation due to, say, but it's basically an event that pretty much mirrored what happened on January 6th in Washington.
Yeah.
That basically took place in Brazil, yeah. And there are some, at least, there's some evidence that if it wasn't planned, it was definitely intended to basically end up in a coup, which of course it didn't. It was just a bunch of dressed up guys running around in a big hall screaming and stuff, just like we saw in the US. Only there weren't that many casualties and stuff, and people getting beaten up and all that. And it seems he, to some extent or another, was involved. It's unclear how much, but yeah, it's definitely returning a favor, because it's not like Bolsonaro did much good for Lula once once he was president. So there we are. Interesting, but I don't think it's that major an event for markets right now.
No, and as far as I recall, the pictures from Brasilia, the big difference between Washington, the pictures from Washington and Brasilia was in Washington, we saw like the crowd in Viking suits and helmets and all that, and in Brasilia most of them actually went inside
football
the buildings
shirts.
in football shirts with Neymar on the back, right?
That's where you were down there.
But never mind, Emil. Brazil is currently, in my opinion, a consensus bet. I mean, we've seen positivity around Brazil, both economically, FX-wise, for a while. A stability that we're not used to, I'd say. So what do you make of that? I mean, if Brazil is sort of a wonder child for the EM stock pickers right now, is this something that could sort of wreak havoc with the overall positive picture?
No, I don't think so. I mean, the way that markets basically have perceived Brazil on these past few years is basically a carrot story with some embedded fiscal and political risks to it, right? That's why markets have preferred playing out, say, the Mexican peso, because it's much more integrated into the American economy. But I do think that some time ago, I would question whether that's the case now, but I called it out back then, and it was followed up by an upgrade. So flag that one. I think credit risks were essentially just completely out of sync with the reality, and that has to do with the fiscal path going ahead, which is basically dictated by the Congress, who are basically just tying up Lula's spending habits. So that's a positive. I will say that price action in the real hasn't been that impressive as of late.
No.
But I think if you go in on the real now, you're basically long a call on China really starting to put the foot on the gas here, because then it will absolutely work. So perhaps long real and short yuan could be an interesting bet here. On the flip side of that, when I mentioned Mexico, I'm really bearish on the peso. I think all that it had going forward in these past years that basically drove its overperformance is slowly disintegrating, and we're starting to see that now in the election, which is already full of outlandish promises of more fiscal expenditure in a budget that's already on the loose, and private sector that's slowly losing its momentum. So I think that's a major conviction of mine right now.
Buy Brazil, sell Mexico.
Yeah.
I guess that's a weird but Also,
Yeah.
nice conclusion from the interview with Tucker Carlson and Vladimir Putin. I don't know how we ended up with that discussion, but I think it's time to bring in our guest of the week. We've invited my old boss. I tend to label him the Mufti of macro modeling. He's exceptionally good at modeling macro trends. His name is Mikael Sarwe. He's Swedish. And he's the head of macro and equity strategy at Nordea Bank, my old employer as well. I need to disclaim that. Since Mikkel is Swedish, I think it's timely to use a soundbite from one of the Eurovision Song Contest winners of Sweden. I think they have 10 or so. I mean, they tend to win this contest every second year, but this is the best one of them. So here's the song called Diggiloo Diggiley in the English version from 1984. Mikael Sarwe, my old boss from Nordea Bank, the head of macro strategy and equity strategy at Nordea Bank, still to the Macro Sunday podcast. The Mufti of macro modeling is back at the Macro Sunday podcast. Great to see you, Mikkel.
You too, Andreas. Always a pleasure.
It is. Mikkel, I mean, we've had a pretty weird start to the year, to be honest. Pretty decent price action, especially in Max 7, if you look at it in the equity space. But what do you make of the cocktail of key figures that we've seen from the US economy? Is it feasible to actually sort of paint a story of the US economy accelerating here?
Yeah, I mean, nothing is impossible in this crazy world, clearly. And as you say, I think, to be totally honest, it's been a confusing start to this year. I guess if you look at what happened to the end of last year, I think after all the revisions to savings data and so on during last year in the US, to me, it kind of crept in that, okay, there's going to be a continued boom for last year. I thought that things would calm down quite dramatically early on this year, and they haven't yet. Admittedly, there hasn't been that much data out for 24 yet, but it's more kind of sentiment data and so on. Of course, ISM bouncing up, and perhaps particularly some parts of consumer confidence and so on going start bouncing up, and clearly U.S. data surprises at the start of this year have a surprise to the upside, while I've been expecting them to turn more to the negative side, and that clearly confusing to my mind. Then, of course, if you look at the markets, it feels like a very strong start to the year, and it has been in terms of overall indices. But as you noted, it's a lot driven by combination of the Magnificent Seven and various AI stuff. If you look at this reporting season so far, you can clearly see that, you know, the stocks that have been performing either has a clear AI focus, or they're one of the Magnificent Sevens. With, I don't know what Nvidia is up nowadays, but is it like 35-40% year to date as an example? While if you look at the reporting companies that more have a connection to the real economy, they've not, I think, performed, but rather they're down year to date. And also looking at kind of being in cash in the US versus being in the equity market, equities on the major indices have clearly outperformed. But if you look at the equal weighted stuff like equal weighted MSCI in dollar, you would still have been better off this year to be in cash, actually. So it's a very strange start to the year, I would claim. And what's also been happening, and I mean, we both you and me being in the Nordics, you can clearly see in the Nordics that the type of companies that have performed during this earnings season or the start of this year has been partly defensive sectors like healthcare and so on. And the other thing is that quality companies, i.e. companies that have shown a stability on return of capital employed and stuff like that over time, which normally outperformed clearly in recessions or bad times, they've outperformed massively during this reporting season. Yeah. So it's I don't know what to make of it, actually.
Well, that's always a good outset for a discussion.
That's comforting, right?
Indeed it is. So, Mikkel, I know that you track, for example, US GDP, US inflation, US unemployment on macro models. Yep. What are the models telling you right now? If you only listen to the models, is the recession still in play here?
If I only listen to the models, yes, they are. However, if you look at they looked more negative last year, but of course things were saved by both huge fiscal policy stimulus from Biden last year and the old sort of stimulus checks. So it didn't really play out. They're still in negative territory clearly when we're going into 24, but they're not as negative as they were last year. So it is a little bit like, okay, was it the case that they actually saved the economy from the recession by this huge, and they were really huge fiscal stimulus last year, and there will be no recession, which is basically what everyone thinks right now, or is it just that we will see now in reverse that the fiscal policy or the fiscal stimulus will, turn this year and be at least not positive, but at least flat or even perhaps a little bit negative, and you will get it as a shock basically towards the middle of the year. The models are kind of indicating that will happen at some point. So I'm still in the negative camp. So I'm still kind of thinking the idea that you should in equity space stay with the defensive sectors, and I'm not. It wouldn't surprise me if we actually sort of are testing the old lows this year in the equity market. But then again, I got that part of it completely wrong last year, so I'm kind of humble about it, to be honest.
If we look at the forward-looking indicators on inflation and wages,
Yep.
we've seen a couple of weird data prints, given the point in the cycle that we at least seemed to be in late last year when it comes to wage indicators. For example, the NFIB survey on compensation plans now looks extremely hawkish on wages again. So what do you make of that inflation and wage picture, both in the US but also elsewhere?
No, and I think it's a very important question, and clearly, if you look at more leading inflation data, they are accelerating again, both in terms, as you alluded to, the compensation plans part of the NFIB, but also I think if you make a general wage model, they're still not telling me that wages will come down in terms of yearly rates, and rather that they will be stuck where they are today, and some of the indicators are even accelerating as the NFIB. So I mean, the Fed currently is kind of thinking that okay, wages have come down a little bit, which they have, I think, on the broad terms, and that will continue in 24. So far, I would say there's very little evidence that will happen on that side, and you can also see it in terms of price plans in the NFIB, which, I mean, it's the most domestic part of the US economy, and they're not signaling that they are cutting prices or sort of calming down. The other way around, they're sort of those indicators are rising again. And then, of course, we have the huge divergence currently between what the Fed is looking at, which is the PCE deflator, and what's going on in CPI. I mean, if you look at the median PCE deflator, that's kind of in line with the target and signaling and all clear to cut rates, while the median CPI is, I think, at around sort of 5% if you annualize it right now. I mean, I guess this will be aired on Sundays. We will see if the revisions today on CPI will change that. But currently, there's a huge divergence, and I guess for the people, I think they sort of more are seeing the CPI. That's what's hitting them. The PCA is something different, but that's what the Fed is pointing to. I think it's a little bit crazy that they've so one-sided just looked at PCE right now. Of course, it suits their story, but that could also be a reason why Powell couldn't be more dovish here in January, because I have a feeling that some of the older governors and the more sort of heavy hitters in the Fed kind of know that there's a huge divergence right now, which is probably so you know, one reason why he couldn't sort of, or one reason why he clearly said that there will be no March cut, and to me, as I said, I think it was a great year, most parts of last year, in terms of inflation coming down. It looks like the first half of 24 will not be the same, that we would rather have an acceleration again.
And that could obviously wreak havoc with the cutting plans of both the Federal Reserve but also other central banks.
Yep.
So, I mean, given this potential reacceleration in inflation, how should we view the path ahead for the Federal Reserve and other central banks?
Yeah, and I think it's a good question. Of course, in Europe or in the euro area, inflation has come down more than in the US if you look at the underlying parts. And I guess if you look at the 3-month rate of the core inflation, it's clearly below 2 right now in euro area. But there as well, if you look at the two last months, it seems like it's accelerating again. And I also would say that if you look at the ECB inflation expectation survey that was out earlier this or recently on the consumers, the 1-year expectations are still quite high, indicating that probably there might be bounce also here in terms of inflation. And turning that into central banks, I think they've been quite clear about what they're thinking. The market hasn't listened as it is sometimes, but what you hear from central banks are basically, to me, everywhere, that they're totally fine with the market discounting rate cuts. They're not fine with the timing of those rate cuts, and they're not fine with the sizes of those rate cuts discounted. You've heard that from plenty of Fed governors. You've heard it from plenty of the ECB governors. Because I guess the indication is that yes, we will likely cut rates this year because rates are high. But we're not there yet in terms of inflation. Of course, with my inflation view, they will not be there by March. They will probably not be there by May, which is kind of where things are discounted now. So to me, it's more a matter of rate cuts perhaps popping up, to the middle of the year or the second half, rather than what the markets are doing. And then clearly what Fed governors are saying now is that when they start, it will be a very gradual move, which is not what the markets are discounting.
No.
Now, that is, of course, that will depend on what happens with the business cycle. I'm, as you know, much more negative than most. So in my mind, you can really, doesn't matter if the Fed and the ECB said that they will be gradual. If I'm right in terms of the economy being quite sour at the second half of this year, then they will cut more aggressively at that point. But I do think that still it's too large rate cuts discounted too early. At the end of the day, I think they will probably cut more than is discounted, but that's later on.
I remember during last year we had a discussion on the perfect timing of receiving interest rates, so buying into the US Treasury space. And you had a very simple rule of thumb. As soon as the Fed is done hiking, you should start slowly but surely building up such a position in interest rate space. So does that conclusion still hold on a trend basis? Does it make sense to add exposures to, say, 10, 20-year fixed income here?
I think so in the US. I mean, as you hear, I'm split on the subject in terms of I think that there's still too early rate cuts discounted, and I guess that's why rates have been going up from like 380 where it was heading into this year, and now we're like at 415 or something in the US 10. So you need to I think you still need to push some of the rate cut expectations further out in time. But overall, definitely, and it played out relatively well. I guess when we headed into 23, my view was that we were going to see 5% US 10-year yields, which we did. And then, as you say, that at the point where usually the Fed is starting to indicate it's done, then you have the peak, and that was more or less exactly what happened. Then I think I was perhaps a little bit surprised that it rallied as hard as it did from October up until now. That we went from 5 to 380 on basically nothing in terms of data, just sort of a market speculation move. That surprised me that it happened so fast. But now, of course, we've given back part of that, and it looks more reasonable. But this year, my view has been that okay, we need to take up rates a little bit here early on this year because of these inflation indicators, but also that the U.S. economy has continued to surprise more positively, clearly, and that. But at the end of the day. Of course, in my recession scenario, then rates will be much lower at the end of this year. Now, looking at sort of the euro area, and for that matter, Sweden, where I sit, it's of course, I mean, rates are a lot lower, and of course, a 10-year yield in Germany of 230 or something, where it is now. I don't know if that is a good buying opportunity for the medium term. To me, I think sort of 2% is probably where we will end up in this cutting cycle at some point. I'm not sort of I'm not. I don't think that we will go back to these zero negative rates in this cycle, because even though we have a recession in the euro, it's still a bread and butter recession. It's not the financial crisis. It's not sort of that type of recession. and then we shouldn't really. So I would clearly be more interested in buying U.S. bonds than European ones.
If we look at Europe and in particular Sweden, where you're situated, we've talked about Sweden as a leading indicator for the Eurozone, maybe even a leading indicator for global growth. What are the models telling you about the Swedish growth picture? And should we expect Sweden to lead the world again this time?
Yeah, I still think so. Yes, that you should look at Sweden as sort of a leading indicator, particularly in terms of getting the rate hike effects in earlier than everywhere else, because we have a lot of variable rate loans, but also in terms of being very export oriented and sort of being a small, very open economy. And I think what I see is that clearly most of the rate hike effects are now in the numbers. So of course we had a very negative year on personal consumption last year, which dropped something like 2.5% in real terms, sticking out compared with everyone else, basically a very, very weak year. And of course now we probably will not see any more rate hikes. Not all rate hikes are not in the numbers yet, I would claim, but anyway, I think we passed that part. I think now what I'm looking at is more the labor market side, where in Sweden, of course, unemployment is up over 1% since the bottom. So it's we clearly moved into the deterioration of the labor market side, which we haven't done really yet in the US. Some indicators have clearly, but not overall. And I think the rest of the world will follow. We've seen it in Germany for quite some time, as we know. We're starting to see it in France now, while the other countries are keeping the euro area unemployment low. So I still. If I look what I think on the economy and what I hear from other economists or more economists here in Sweden, they are clearly less pessimistic than I am. I think there are still what we were going to be working with this year is a quite large increase in unemployment, which no one really has in its forecast. I think that will sort of play out now. We hear it now a lot. Also, I would say in the Q1 reports that a lot of companies are signaling that they need to take down their workforce in Sweden, but also globally. And then I think the other thing is that clearly in Sweden we've been riding on a wave of old order books saving the day on the export side, back from COVID times basically, and together with a very weak SEK that has now also turned around. So you've had a huge tailwind from the currency, and also a huge help from order books. So I think the problem now is trying to figure out is that companies are kind of indicating that that the order books are still fine. The new orders clearly are not fine. However, I think it looks like they stopped falling in a sense. I mean, they're not deteriorating, and then you need to sort of figure out what will that mean. In my mind, I think looking at particularly the equity market and how the industrials are trading here in Sweden and Nordics, and looking at valuations, they're quite high compared to history, and they're kind of assuming that the order books will improve this year. I think that I don't think that new orders will deteriorate much more, but order books will probably drop quite dramatically because the level of new orders are so low compared to the order books as such. And so that is one reason why I have a more negative view and tilt on things. And then the last thing is that even though that, I mean, we've been seeing sort of the real estate problems, and of course you've been working at a real estate company, so you know that well, for quite some time here in the Nordics. That doesn't mean that all of the effects of that is through the economy, because completions of particularly residential units were all-time high in 23, and they will just collapse in 24. So I think there's an underestimation of those kind of more long-term negative effects on the economy that has been keeping up activity in 23 while consumption has been weak. Now I think we'll see everything else being a lot weaker this year, and that will sort of lead to the labor market being weaker than people think. And I do think that is also what will happen gradually in the US and elsewhere. Of course, in the US, I mean, looking at labor market data there, hiring it seems to be off a cliff right now in terms of sort of dropping quite fast. And that usually, then it takes 3 to 6 months, and then it hits layoffs and so on. So I think we're in the early stages of actually a quite clear setback on the labor market in the US.
if we look at real estate, I think that's a great way to conclude this interview, Michael. The Swedish real estate sector obviously suffered in 22-23 alongside the rate hikes. It seems like if we look at market-based gauges that we're at least past sort of the trough in activity in real estate space. I don't think any sector outside of home builders in the US celebrated Powell's pivot in the autumn more. So obviously that sector is extremely keen on interest rate cuts. If it takes a while longer to get those interest rate cuts, will that sector be back in the limelight as a negative?
It clearly could. I mean, if we take in the Nordics as an example, I mean, I had a negative call on the real estate market for all of 22, and sort of being clearly underweight, which is, I guess, one of the best things I have done, to be honest, because of course it totally exploded during that period. But then we sort of looking at what's been going on, and particularly looking at, okay, we're probably very close to an interest rate peak, as I thought, sort of heading into Q4 last year. We actually turned around and became positive on the real estate sector in September, which was a little bit early because you still had the sort of final push higher in interest rates in October. But since then, it's bounced fantastically. And of course, with interest levels where they are today, it sort of alleviates a huge amount of problems for the real estate sector, because and I think, and what we've been seeing clearly is that the latter part of last year has been a huge amount of real estate companies in the Nordics that have taken advantage of this and basically locked in these lower interest rates, which will make them survive, to be honest, in a very, very good way. Which means that even though if we push back a bit on the rate cut expectations, I think most of them have locked in these lower yields now. So I think they'll be pretty fine, actually. Then, of course, in terms of markets, clearly, if interest rates go up a bit, and we've seen it early this year, rates have been going up, and we had a very strong performance of the real estate sector as long as interest rates fall. Now we've given back a little bit of that. But I think in general, and broadly speaking, I still think that real estate in the Nordics is a very good medium-term buy. Then, of course, me being more negative in terms of what I think of the economy, I would be a little bit more cautious on the part of that side which has a lot of office rentals, stuff like that, because I guess there will be some vacancies showing up there. But as the sector as a whole, I think sort of hit the bottom last year, and it was a fantastic buying opportunity for a medium-term call, and I still think that is the case. It still looks very cheap, I think, when I look at it compared to history and compared to other sectors that look pretty expensive, I would say, a lot of them.
So thank you very much for reminding me that I worked in the sector during the worst 18 months of that sector's history. But I
you
guess
seem
I
to
have
have
to
survived anyway, Go.
Yeah. I managed to survive anyway. Mikael Sarwe, always a pleasure to have you here on the Macro Sunday podcast. Let's bring you back on the podcast in 6 to 12 months' time and see whether that recession arrives.
Sure. Good speaking to you, Andreas.
Back in the studio from the interview with Mikael Sarwe. As always, great to see Mikkel again. And Emil, I have to comment on the on the song we played before introducing Mikkel. Dickaloo Dickalay, the winner of the European Song Contest in 1984, as far as I remember. For some reason, and we're obviously biased since we're Danes, the only thing that the Swedes are capable of winning is the Eurovision Contest, but they win it all the time.
Music-wise, they beat us to a pull, no doubt.
Yeah. ABBA is to be preferred over cartoons or whatever.
Yeah, Aqua.
Without a doubt. So, Emil, Mikkel actually posted a pretty positive view on the Swedish real estate sector. And I think that's interesting, given how the Swedish real estate sector worked as a sort of early indicator of real estate sector trends elsewhere around the globe. And when we look at the price action in Swedish real estate since, say, early autumn or thereabout, we do see some positive signs now that interest rates are probably past the peak for this cycle, right? So Emil, I know you've been tracking the commercial real estate space fiercely over the past couple of weeks, also with the reemergence of this sort of regional banking scare with New York Community Bank in dire straits on the exchange, etc. So what do you make of the real estate picture here? I mean, it's not really a strong performer in the US equity market so far this year.
No. Well, I basically think that we just kicked the can down the road from last year, essentially. All the weakness is still there. The insolvencies are still there. To what extent have has the financial easing really helped? Not that much by the looks of it. Unless we see a substantial move in collateral price, that is, offices essentially becoming, hot again, which I don't see happening. And to what extent do we see rates basically undo some of the pain it has imposed on the sector? I mean, listen, it's carnage, but it's not a new story. So you would suspect that the Fed are all over this. But I think what happened with the New York bank, it's at least raising some doubts, if not some outline questions on what's going on with the regional monitoring of the situation here within the Federal Reserve. I think that's something to keep aware of.
And it's kind of amusing, right, that New York Community Bank bought at least parts of the Signature Bank. Signature Bank went bankrupt in March 23. They bought it from the FDIC with, I think, a haircut of, was it a bit more than 20%? And 9 months later, the FDIC shows up and basically tells the New York Community Bank, well, you bought a truckload of shit from us. I know it's kind of exaggerating what happened, but I mean, it's not entirely wrong. And on top of that, New York Community Bank obviously moved up a tier from a legislative perspective, meaning that they had to set aside a larger buffer and all that. But I think this is a very gentle reminder that the issues surrounding CRE are still very present in the regional banking space. I mean, Jamie Dimon couldn't care less. He's probably just hoping for a good couple of targets that he can buy. Right?
He's looking for others. Yeah.
If we look at the broader ramifications of this, one thing that we had extremely right in March last year, Emil, was that we started buying into tech, AI, and all of that right around the timing of all of these bankruptcies in the banking space, because it seems like the Federal Reserve, especially also given the timing of this, that they're ready to just throw liquidity at the issue if it pops up again, right? And what's your impression here? I mean, the BTFP, the Bank Term Funding Program, obviously ends here in March, but do they have something up their sleeve if they need to?
So, if I understand it correctly, and I'm pretty sure I do, there's still 1 more year on that program, even though it runs out.
Yeah. If you take up a loan a day ahead of it running out, there is a year left.
Yes, exactly. But I think what happened with the New York Community Bank sort of puts into light the recent arbitrage, right? That's interesting. It's interesting that a bank that the Federal Reserve should basically have, at the top of their monitoring list, gets hammered, even though they were involved in acquisitions of basically one of the casualties of the banking crisis, and they still get, apparently that wasn't enough for them to see it coming. And then you have this arbitrage deal via funding, right? I think that's sort of telling me that they're not 100% confident that they have really the full grasp of the situation. So why not just preemptively throw some liquidity at the sector to see if they can, get some cash back on the balance sheet before the circus really hits town, right? The refinancing rounds due this quarter in the commercial real estate space. That's something I'm thinking of right now. But as far as systemic threats, I don't really think they're there, but it could essentially catapult the risk off, which could have ramifications on the labor market, to be fair. But I think the Federal Reserve are on top of that part. So I would suspect that they have some sort of plan ready in the drawer. And yes, I think it will involve basically the same thing that we saw with the Bank Term Funding Program, which is essentially a backstopping. banks who are long duration in the wrong manner, right?
Yeah.
So those who who took risks, they're gonna get saved, you know.
Yeah,
Fine
as per
incentive.
usual. As per usual.
Yeah.
So I mean, currently we're long the XLK, the tech stock
Yeah.
fund, and I mean it's been running on a high for a
Yeah.
while. I still like the position, given that this possible influx of liquidity is still there as a positive driver. We know that there will be an automatic influx of liquidity due to the depletion of the ONRRP facility at the Fed as well. So it kind of seems like the playbook is still that we need to find the trades that are sensitive to a dollar liquidity influx, despite all of the uncertainties that we see around the macro picture as well. And Emil, this week we took on a position of being long the Japanese yen. It's been an extreme widowmaker trade, but we've traded it versus the Swiss franc. I'll allow you to elaborate a bit on your thoughts around why a long in Japan could work here. Also in light of all of this liquidity, these liquidity discussions in the US.
So I looked through the minutes of the last meeting of the Bank of Japan, and it came quite evident to me that there's very little chance that they aren't going for the positive rate zone in the front, and that essentially, I mean, it shouldn't really overly surprise markets the way they're positioned, but nonetheless, I think it would be a net positive on the yen. And on the flip side of that, do you see let's say that the dollar goes on a tear? Do you see the Bank of Japan accepting the yen going past the 150 handle?
No.
I doubt it. So that's basically the range that we're trading. You know, higher upside than downside from this point. So yes, I'm into it. I will add that on the tech trade, which you have basically convinced me into, though I happily you did. I think the CPI, and then we have, I think it's Nvidia who are delivering their earnings the week after. That's going to be interesting. I mean, as far as one earnings call for the entire equity market can matter, I think that one is probably something to look out for. So that's on that side of things. But yes, I think it's interesting, because usually we would say that a strong yen is not necessarily all that good for US equities, right?
No, true. But
So
a lot of correlations have flipped over the past couple of years.
Yeah.
Also in relation to the Japanese yen. I may add that Ushida, so the deputy governor of Bank of Japan, made some remarks over the past week here, and those remarks were interpreted as pretty dovish. He basically outlined a very, very gradual rate hiking cycle ahead, but still the sequential changes in the direction of rates up, which to me is more than enough to convince me that it's a smart move to be long the yen, given that the sequential change is down elsewhere on interest rates. But I kind of got the vibe that we're talking about 10 basis points at a time from Bank of Japan. I mean, he clearly referred to this being baby steps, or whatever it's called in Japanese. And I mean, 10 basis points at a time would move them out of negative territory already at the first rate hike, right? They will get back to zero. If they move 10 basis points at each of the quarterly forecast meetings, say in April, July, and October, they'll deliver 30 basis points this year. It's actually more than what's priced into the Tonar curve. So, I mean, the market is not overly convinced that the Bank of Japan will do 25 BPs at a time, or 50. I mean, it's out of the question. They're not doing it. So the only question here is whether it's feasible for them to move, say, 10 basis points at a time over the course of the next year, with everyone else cutting, if that's the case, right? I think it is, since they have an outset of an extremely weak yen, which is essentially the exact opposite of the Swiss National Bank. They have a very strong Swiss franc going into this cutting season.
Yes.
So they'll have to follow suit when other central banks cut interest rates. And the Bank of Japan is not in that position.
No. And I will add, if you remember when Ueda he took over office, his first his first move was basically to just pull the rug beneath everyone, surprising everyone in the summer. You remember, and I think he's very much aware that that's the way you should go about it. You shouldn't let the market front your policy choice here, but you should stay in charge, and that's because they know the gradual direction of monetary policy, unlike some other people we shouldn't mention. And I think that works in the favor of it, right? So basically, to me, it's basically a range trade that has more upside than downside. That's why it makes sense to be long. That's how I look at it.
Yeah, so long Japanese yen versus the Swiss franc, relatively carry neutral. It's slightly negatively carrying, but relatively carry neutral relative to what you could trade the yen against otherwise. Emil, I think
traded against the wang as well.
Yeah.
So,
that's also a possibility for sure. Emil, I think we will leave it at that for this week. It was great seeing you again, and I think we need to remind our audience of the best disclaimer in the world. So now that we discuss trade ideas, here is Gennaro Gattuso with our broad disclaimer of what we just said.
Sometimes may be good, sometimes may be shit.
Referring to our trade ideas. Thank you, Gennaro Gattuso. Thank you, Emil, for joining us. Thank you for listening to the show or watching it on YouTube out there. We'll be back again in a week from now with more in the Macro Sunday podcast. Remember to go to stenoresearch.com. Always 2-week free trial for our research product. And I'll see you soon.